We've seen companies like Kingfisher and Jet Airways go bankrupt due to massive loans on their backs. But what about the ones generating just enough revenue to cover their interest payments? These companies have been assigned a special status known as zombie companies. What is a zombie company? As the term suggests, zombie companies are the one whose interest charges or debt obligations exceed their EBITDA. Simply put, the company is unable to generate sufficient profit to pay off its debt. Such companies tend to have an interest coverage ratio of less than 1. Let's take a look at how many we have in India. On the other hand, we are on the verge of another major correction due to high inflationary pressures around the world and desperate attempts to control it with historical rate hikes. The combination of rising debt costs and declining purchasing power has created an extremely unfavorable environment for small businesses. What happens to the economy if a zombie apocalypse occurs? No, not the one that you've seen in the movies, a financial zombie apocalypse. Japan experienced such a situation in the 1990s, which became known as the Lost Decade. Between 1985 and 1990, a dangerous combination of economic mismanagement and excessive lending resulted in the bursting of a massive asset bubble. Individuals who received loans bought real estate, causing the value of land assets to rise. Borrowers then used these assets as collateral to obtain additional funds from banks. The entire debt-fueled house of cards began to crumble in the late 1990s when the Nikkei stock market crashed, wiping out $2 trillion in the first year of the decade. We saw a similar situation in 2008, and as long as we continue to bail out these sick companies, the bubble will continue to grow. Keep up with our weekly analysis by clicking the follow button.